Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right. I'm back here. This is the Investor Coaching Show, Paul Winkler. Talking money and investing. So, we've had a little run, haven't we? Markets have been interesting. So far, at the end of the quarter for 2026, you had the S&P down pretty significantly, and then, other market segments, most of them up. So it was one of those things where diversification, I'm always talking about, make sure you're really diversified because you just don't know when stuff like that is going to happen. And then you'll have people that'll come out there and they'll say, hey, here's what I think is going to happen next. And I always lampooning that. And so I thought I would give you a couple examples this week from TV and just some comments. I think all of this stuff is educational. When you hear these types of people talking about this, I had a conversation with a guy earlier, and he was talking about a friend of his choosing companies and stocks, and he had done really, really well, and then when lost, everything went down, and then he lost everything he made and then some. Had one company he had bought, and it was a penny stock, so he very, very cheap, very low cost, made a bunch of money, and didn't end up losing all of it. And I says, I always tell people, when somebody engages in that activity, the best thing that can ever happen to them is for them to lose right off the bat. Because if you lose right off the bat, then you don't have this false sense of confidence and ability, that you have this golden gift, as I like to call it. You get that out of your system right away. It's probably best to do that. But some people don't seem to get that message. And a lot of times they'll tune into programs to hear what they think is going to do well next and the areas that are going to do well next. And commentators will always have an opinion on what the stock market's going to do.
Single major stock, with the exception of Apple, looks the worst. I mean, I know that it's absolutely right. It's not 2007, 2008. But I also know that there are many people in the last few weeks who have told me, maybe it's my age, but what's going on? I don't want to lose what I've had over multiple years, but I'm losing it. I'm losing it in big cap stocks. And, I'm talking about Microsoft.
And there's an example right there. You have companies that are well-known, well-liked, and you think you're going to get a higher rate of return. He named Microsoft right there. And somebody asked me about Coca-Cola the other day. And I said, well, Coca-Cola, okay, what is it you like about Coke? And he goes, well, they're a good company. And I said, what's so good? Oh, they're just well-run, good product. It's just a well-run company. And I said, so when you invest, you're letting companies use your money, right? And he said, well, yeah, I guess. And they've got to pay you the earnings commensurate with the amount of the company that you own. So if you own 1/1,000,000th of the company, let's say, that's how much stock you have, then you get 1/1,000,000th of the profit, whatever percentage. And I said, so you have this company you think highly of and invest in it. And I said, you think that they're going to pay you more earnings. You're going to get higher return for the use of your money. That would tell me that you think that the company isn't very smart, that they're willing to pay you more to use your money. And he goes, well, I hadn't thought about it that way. And I said, hey, let's look at the cost of using your money in large U.S. companies. And I said, so you get $1 of earnings for every $16 that you pay historically. And I said, so if you take 1 divided by 16, it's 6.25%. Let's say the number's 10, just to keep the math easy. You get $1 of earnings for each $10 you pay, and that would be what a value company would cost, by the way. So you have a 10% earnings yield, 1 divided by 10. I said, if that number is 20 that you pay, that it's really good, that would be a lower rate of return, right? 1 divided by 20 is 5%. If it's 100, it's 1 divided by 100, which is 1%. And he goes, okay, I get it. Good. Okay. And I said, so what is Coca-Cola selling for? And, when I looked at it, it was selling for about $25, $26. So it's selling for a higher price, which would tell you that the earnings yield is lower. So it shows you that a good company would be rational and they'd want to pay less to use your money. Because, oh, okay. So this guy's saying, I don't want to lose, this is Kramer talking. People are saying, I don't want to lose it. I don't want to lose on big cap stocks. Well, that's what happened. A lot of people, they have these big run-ups and they think, they read things that say, hey, just index your portfolio by an index fund. A lot of index funds, index funds are going to be weighting over cap-weighted index funds are going to be overweighting bigger companies. That's by definition. That's how they work. And when they're overweighting those big companies, now you got a problem in that when those big companies come down in value, and that's what a lot of these people are worried about. They're watching this retirement money just dry up because markets go up and they go down. And those areas of the market, I'm going to tell you right now, S&P 500, total market portfolios, they're very high price compared to earnings right now. They're very, very high price compared to book value. It doesn't mean I know that they're going to go down in value, but they have a very high likelihood of dropping back down to earth again. And that's what people are worried about. And that's what Kramer's saying right here.
Not in a bear market. That's been like in a colossal, giant grizzly market. Look at that. That's not a bear. It's not Yogi. I mean, that's the one that Al Baldwin couldn't kill. Remember that one? That's what's going on in that one.
It's a grizzly bear.
Holy cow.
It's not Yogi Bear.
NVIDIA's down huge since GTC. I mean, GTC was an amazing event. I was there. I couldn't believe it.
Yeah, that's terrible. And when it happens, it's awful because you just can't get out in time. And that's basically what he's talking about there. People, look at this stuff and they go, man, wow, this is just like awful. And this guy and I were talking about back when, in the 2000, 2001, 2002. And this is when I met him. He's been a client for many, many, many years. But we were talking about that. And he says, oh man, I just remember what it was like. And I'm thinking I'm bulletproof. He says, I would open up a newspaper. He says, I kid you not. And I would take my finger, I'd close my eyes. And he said, I put my finger down on the newspaper and that's the stock I would buy. And I couldn't lose. It didn't, no matter what I did. And I said, yeah, that's what it's like. Everybody's a genius in a bull market. That's a very common phrase in the investing industry. And everybody's a genius when large U.S. stocks and markets and S&Ps, going up in index funds seem great. And I'm a big fan of the concept of index funds, which you're just capturing market returns. You're not trying to stock pick. You're not trying to market time. You're just capturing market returns. And that can really go against you when markets turn the other way. And, that's what happens. These people will admit that it is a big challenge. I mean, just check this out.
Holy cow. And look, NVIDIA's down huge since GTC. I mean, GTC was an amazing event. I was there. I couldn't believe it. It just didn't matter what they said. That's preposterous. It's a major American company that is ruling the world when it comes to the most important thing, which is AI. And the stock was night through butter yesterday, night through margarine.
After
when we didn't have any butter.
After what period of time do you start to defer to the wisdom of the market when it comes to the way it's valued?
Oh, hey, professor, this market knows more than I do. It's
Finally, he admits it. This market knows more than I do. But catch what he's talking about right there. You can hear the frustration. You get a company like NVIDIA, and you go, "This is a really great company. They're that's ahead of everything on A. They're such a well-run company. They're always interviewing the CEO of the company, and the guy is brilliant, no question about it. And the thing that happens is these companies, they go up in value, people get excited about them, and then they come down, and there's no place you can hide. And you can hear somebody saying, hey, I thought this company was great and it should go up forever. And then all of a sudden when it comes down, it's like they're shocked. How could this possibly happen? But that is really the issue at hand when it comes down to investing, is that we may be looking at companies and say that they're really great companies. I love these companies. I think they're well run. But that doesn't mean they won't go down. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, like dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right. Back here on the Investor Coaching Show, Paul Winkler. Blue Owl investors seek to pull $5.4 billion from two private credit funds. This is another I told you so, I told you so, I told you so. This is something I've been talking about a lot over the past several weeks. The whole idea is it's going to be a great idea for investment advisors. Been getting all over this. I've been hearing so much about it, and I've been hearing so many commercials about this type of thing. We're going to give you access to this stuff, private credit, private equity. This is going to be a great thing. We want to be able to diversify, invest. They use all the buzzwords. We want to diversify investors, give you access to more different things. Hey, the rate of return on these investments has been higher, and you deserve higher returns, don't you? I mean, don't you just deserve higher returns as an investor? Doesn't it make sense that you ought to be able to get better returns on your money? And you think, well, yeah, that does make sense. And private equity, that has been the area that wealthy people invest in. And, I want to be like a wealthy person. I want to make sure that I invest in the stuff that they invest in. And, pension funds, for example, they get to invest in this type of stuff. And I shake my head and go, you know what? If you only knew the data, you wouldn't be so excited about this stuff. Well, that's what this article talks about. It says fund manager reverses course and limits redemptions to 5% as outflows accelerate. Again, once the outflows start, once the money starts to flow out the door, it's just like, Katie, bar the door. How do you how do you deal with this? And this happens so often with investment products. People come in and say, hey, we're going to give you a 5% rate of return, 7% income on your money, and you'll be able to draw an income from this portfolio, and that's what you need for your retirement. And then all of a sudden you get in and you can't get out. Well, that's what's happening here. Investors requested to withdraw $5.4 billion from two Blue Owl Capital private credit funds in the first quarter. The redemptions represented 22% of Blue Owl Capital's $36 billion private credit fund and 41% of a technology-focused fund. Again, how many times are we going to get excited about technology as investors? I mean, didn't people learn their lesson 2000 through 2002 when you had a decline of 80% in the technology sector? You had companies and investments go down 80%. Can you imagine you're sitting there going, I've got $1 million and I'm ready to retire. And you're all excited. And then all of a sudden, I got 200,000. I better work a few more years. And, people call up the radio show and they say, Paul, I got this and I went down this much. And they would say, I've just got to hang on. I just got to hang on till it comes back. And I'll say, well, why do you think it's going to come back? Well, it's got to come back. It was selling for this before. It's got to come back. And I would say, well, maybe eventually. But, the reality of it is what got you into trouble is probably not the thing that's going to get you out of trouble. If you got in trouble in high school for hitting your friend, quote unquote, Timmy, you're probably hitting him again is probably not going to get you out of trouble. It just doesn't make a whole lot of sense. But that's what people do. They invest in something, it goes down in value, and they hang on thinking it's going to be the thing to get them out of trouble. Now, there are times to hang on. If you're in a well-diversified portfolio, you wouldn't be down. In you wouldn't have been down much at all in that period of time where, the stocks went down. You actually would have gone up in year 2000. You would have gone up a little bit, and not much, but you would have gone up some in 2001 if you were well diversified. And 2002 is only a slight downturn. But, if you're in a well-diversified portfolio, like in a 2002 where it didn't matter where you were, things went down, at least it makes sense to hang on because you know that things historically, markets always bounce back. But if you're sitting there in a portfolio that was just a plain mistake, it doesn't make a whole heck of a lot of sense. Whenever you figure out what prudent is and you determine that what you were doing wasn't prudent, well, then what you do is you go and be prudent. That's the prudent thing to do. But anyway, it says here, the Treasury Department called a meeting with regulators to discuss risk in a private credit sector amid pushes to include it in 401k plans. Is that what it takes, for the government to go, maybe this isn't such a good idea? When people start losing and then they start to see this stuff, can we not apply academic study and research and thought and logic before we do things? Wouldn't that be a great idea? What a novel approach to investing. Look at, and this is why so often over the years, I have made comments about things. I'm going, this doesn't make a lot of sense. I wouldn't do this. And, and I would say that before it went south. Over and over, and doing this radio show for 25 years, I have, coming up on 26, I guess, but I have over and over again walked through things that I didn't think were prudent. And lo and behold, when it fell apart, I said, hey, and not because I'm a genius prognosticator, it's just some things make sense and they are backed by logic and academic research, and some things just aren't. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.